Welcome back to the Real Estate Reserve Podcast. Jason Bale and Hard Money Bankers, Ian Horowitz, Equity Warehouse co-host of the show. Sorry, today's episode, just me and Ian. We're talking about if I have $100,000, how would I deploy it in today's market? I think my answer and Ian's answers are probably going to be slightly different, which is fine. But I think topics like this are important to think about. I think they're important to think about. You know, everyone's always like, they'll ask themselves hypothetical questions. Oh, if I only had this or if I only had that. But like, be realistic of where you are, who you are, what you're interested in doing, what you're not interested in doing, because I think you'd be surprised. I think you can take a very small amount of money and turn that into a very large amount of money in a pretty short period of time. Maybe not overnight, but a short period of time. And, you know, if investing in real estate is your asset class of choice, I think, you know, that's a great way to do it. And I think there's probably a lot more advantages to doing that in real estate than some other higher risks type of investments. Probably just, you know, our 2 cents on that. So, Ian, looking forward to this back and forth episode today. I think it'll be a good conversation, not only for newer real estate investors, but certainly experienced real estate investors that have, you know, maybe excess deployable capital and trying to figure out where to place it.
Yeah, I think that's where some of this questions, comments, concerns come from of even discussing this topic. You know, we had a long conversation about a friend of ours who's raising some capital for a deal. And I said, man, I'd actually toss some money in that just to see how it works. And I think it kind of brings up the question of, if you had $100,000, how would you deploy it today? So guys, we're going to have a real fun conversation. If you get any value out of this show, please feel free to share it. We don't care about the likes or subscribes, but just having real conversations with real people is what we like to do. And today it's just Jason and I. So we're going to have a real fun conversation around, if you have $100,000, how would you deploy it? And first off, I'm going to go back to my original story. Is I started with $15,000 and we built what we have today, you know, close to almost 9 figures in real estate, right? So it can be done. And relatively speaking, $15,000, you might be saying, well, that's not a lot of money. And you might say $100,000 is a lot of money. I think the point is whatever capital you do have to deploy, you need to find an appropriate way to do it and treat it like a family office, right? You know, too many people are like, oh, I'm just going to trust the government. I'm going to stick it in a retirement account and just make sure that it's there when I'm done. But we all know how tumultuous the markets are, how crazy everything is, how many fees come out just on people managing your money. You can't even outpace sometimes. And I think that's where this conversation becomes real interesting. So I think it's become a duel, and I don't know who's going to shoot first. So I'm just going to lay it out there and say, Jason, if you had $100,000, how would you deploy it in today's market?
Well, we should put some ground rules down related to, Is this my only $100,000? Is this my first $100,000? Or is it like, hey, I have an excess of $100,000. How would I deploy it? Because, you know, I think for folks that have a good, they're pretty well off. They're looking at, you know, wealth preservation more than, you know, than growth. And there's a difference between actively investing and passively investing. And, you know, if you're at the wealth preservation stage, if you're in the passive investment stage, you're not going to be able to achieve the returns to double, triple, quadruple those numbers quickly like you could when you had $15,000 and you can flip a house and made a good, you know, a big profit on that. Like someone else with $15,000, you know, might be happy with, you know, $1,500 a year in a return, but like that's not going to do anything.
I think we need to look at it from the standpoint of your back's against the wall. You need to know what to do. You need to deploy $100,000. But I also think it'd be diligent to our audience to discuss, you have a good job and you have $100,000 to deploy, and you know you want something other than the standard traditional investments. And I know those investments are going to give you two different things. But I think we should start with the back against the wall one, because I think it's going to produce some interesting answers. And that could be $100,000. You want to quit your job, you desperately want to get out of your job, or you're just looking to do something completely different, or you're having a major reset in your business, whatever it is, you got $100,000 and you want to maximize the return and you're willing to take the most amount of risk on it.
Yeah, the most amount of risk. That's a good way to look at it, because personally, if you have money and you want to invest in real estate and you already have a job, even if you don't necessarily like it, but you have that kind of nest egg to fall back on, that's when I believe it's easy to take more risk, because, hey, listen, if you lose $100,000, that's a lot of money. But at the same time, your household bills are paid, and, you have shelter and things like that. So that's obviously helpful in this particular case. And maybe that's also a limit to you, because then your back's not fully against the wall. It's kind of like, hey, but anyways, I get the point. So a few things I would probably take. And again, this is going to be like an accelerated response, meaning like this can happen quickly, but it's not going to happen, tomorrow or the next day. Like, this is like, hey, within a matter of 6 months to a year, probably closer to a year, how do I take that $100,000 and really turn into something bigger that I can, leverage and push forward on? Because I would say the first probably 10% of that money should go to personal development and education, right? Of that investment, like investing in yourself first before investing in an asset class, for several reasons. Number one, like, I'd probably do that in a few different ways. Number one, personal development stuff of, telling yourself that you can do this, and have, self-confidence, stuff like that, making sure that, you're confident that you're going to be able to do this. Number two, also some resources related to the assets that you think you want, an education in the courses, maybe even a mentor of the asset class you think you want to be involved in, right? Like, a lot of folks are like, oh, I like this investment strategy, I can see myself doing that. But then they dive into it. They're like, oh man, I don't know about this. Or there's other investment strategies where, you can get 100% financing or leverage on it, and you need very little capital. And then there's other investment strategies that you're going to need to front load your own personal cash into it that you're not going to get back for a later period of time. And you don't necessarily have unlimited funds to do that. So, so definitely the invest in yourself and education component, I would probably say at least 10% of it goes towards that. I mean, I think, me personally, what I would probably do is, figure out a way to, I'd probably say flip some houses, because I think that's probably and my answer today is different than my answer was, when I got into this business 20 plus years ago. Right. But what it was then was, hey, we need to flip some properties. Let's take this $100,000. Let's not necessarily buy one of them in cash, but let's try to buy a few of them, but also do it in a responsible manner. And, we had headaches early on when we executed very well on one-off deals. And then we tried to do more and more and more at the same time, and it turned into a disaster. So I would probably say, take that money, not necessarily turn that into, and there's an argument that you can do this without any money, right? There just is. Hey, just go raise all the capital, do this. But if you have some money to put into it, your life's going to be significantly easier to do so. So I'd probably say, maybe take that $100,000, 10,000 of it go into some education, make a goal of doing 3 deals in the next year, with the goal of putting $30,000 into each one of them as down payment money, reserves, interest carry, things like that. Try to get some bank leverage, and potentially take that $100,000, try to double your money on it. Try to make $30,000 on a flip. I mean, it's hard to make a ton of money on a flip. I mean, the more it's risk versus reward, right? Like, I wouldn't try to hit home runs. I would try to do like smaller lipstick on a big projects, and try to get singles and base hits and doubles at the beginning, and try not to get too big. Like, there's certainly opportunities where, speculators and developers are making 7 figures on luxury homes and bigger projects. I think stay in like the lower middle class, median, housing price neighborhoods type of thing. Reduce your risk a little bit, kind of fumble through it, stick to houses that were built after the 70s, because houses that were built kind of pre-60s and before are very, very, they have more risk on it, and the construction costs are just going to be higher. So stick to areas that you know. And listen, if the answer is like, hey, I'm in a higher price point area and, it's going to require me an $80,000 down payment and I might only make a $40,000 return. Okay, we'll do that and turn your 100 into 140 in 9 months. And then you have, more money to do your next deal and your next deal. I personally, I think if Ian and probably agree with this too, I think if we had started over, like we all started with the resources that we had, which were pretty low, and we started in pretty lower end areas in high headache, high time commitment types of deals. I think if I knew now what I knew then, what I know now, is I would have started in just better asset classes. And I think I would have been able to snowball my returns just higher, and they've been easier and better.
It would have been more consistent. It would have been less stress. And it's funny that you bring up these points because I literally wrote them down before you got started. Was if I had $100,000, I would set my intention, and my intention would be, how can I turn that into $1 million in the quickest way possible? Ultimately being able to invest into some sort of cash flowing asset, right? So you need some sort of active income to then be able to produce passive income on the side. So for me, it's funny that you bring that up. I would look for something that you can flip, whether it's wholesale, single family, small commercial buildings, whatever it is, something that you can flip in 3 to 6, 9 months and achieve that return. And I like your strategy of deploying that capital into different assets and trying a few different ones with the whole goal of just trying to get to $1 million. Because then when you get to $1 million, you can take $500,000 and go buy $1.5 million property that produces you, $150,000 a year on that $500,000. And you still have $500,000 to continue to do those flips and continue to hit that seesaw until you build a passive income that is so snowballed that you can't make it stop. It's the same thing. I look at it as I had the fire department that allowed me to grow a rental portfolio that gave me a snowball that eventually allowed me to leave to then be able to dump the active income. And I think that's something that everyone needs to be aware of. So for me, it'd be a target of almost a 10x. And I know there'll be some bumps and bruises along the way, but you want to set that intention of taking that $100,000, turning it into $1 million. Once it's turned into $1 million, go back and looking at buying rental properties. Do rentals fit in? Sure. But again, remember the scenario is your back's against the wall. You need big chunks of cash as quick as possible. And I think single family real estate flips provide that in a quicker fashion, probably more than any other asset class, to get in and out of a commercial building that fast, to get in and out of a rental property or get the income that you need from a rental property, even with a refinance, is going to be really hard. So I think that's the best thing that you probably could do to lever that money up, to put you into a better spot, to ultimately be able to get back to what we all do today. And that's divest into passive income revenue streams from the standpoint of our hits are very small. And then there's equity pops along the way. So I think that's,
I remember like vividly reading the Millionaire Fastlane book by MJ DeMarco. And like, I know it's like a showy type of, kind of looks like a guru book. And, a lot of things in that were, and I was beyond this point at this time, but like, in essence, he's like, hey, listen, most people are chasing around high interest rates, right? And when I say high interest rates, they're like, hey, what if I told you, with someone who's, who's kind of looking to get into the investment games, like, oh, if I can get, an 8% return on this particular investment, that's great. And it's like, yeah, that's great if you have $1 million that you want to lock up to make that return. That is great. But if you're trying to achieve wealth and make money, you need to be chasing significantly higher returns. And I'm talking about, 100% returns or 1,000% returns. And he talks about that in his book. And people are like, well, that's, unrealistic. And it's like, for a passive investment, it's an unrealistic, but for an active investment, it's not unrealistic. And you got to be thinking as an active investor. And, what makes returns like that? Well, interest in businesses, flipping houses, wholesaling houses. you put a property under contract and you flip the contract for $15,000 and you put it under contract for $100 or $500 or $1,000, do the math of what that rate of return is. Now, this is active. This isn't going to a money manager or putting your money in equities or, deploying money to like a hard money lender or buying a rental property. You're not necessarily going to get the returns on that way. This is active, like you're spending the time and the hard work to do so, starting with, the education side, like we talked about earlier, and understanding like what type of investments do that. But, how many houses, Ian, have you flipped in the past that you made 1,000% return on? A lot of them, right? You either got, a high leverage loan from a bank, maybe your company or you personally put up the down payment, or maybe you just raised it from somebody else and you did that. But, do the math. You buy $100,000 property and just you use these numbers, not necessarily this example, not for what it is, because you might not be in an area that you can buy a property for $100,000, but like you buy a property for $100,000 and you put $10,000 into it and you make whatever, 50 grand, return on that flip. What's that? A 500% return, 500% return on your own cash or whatever. You put $20,000 and you make a 250% return. The goal is, and MJ DeMarco talks about this in the Millionaire Fastlane, is getting that 100% plus returns on your capital. And that's not something that most people, including myself, and on my current portfolio, I can achieve unless I'm also the active person as well, right? That's doing that. And but for the purposes of this, you are actively deploying that $100,000, right? You're not just giving that to a money manager. You're not giving that to a hard money lender to deploy that to. You're not giving that to, putting that into like a limited partnership for an apartment building with that money. If you want to do that, then that's fine. But, you're going to turn that $100,000 into $108,000 or $115,000 at the end of the year. You're not going to turn that $100,000 into $1 million.
And I think that's where you need to, yes, up front, setting your intention, right? Like I know the scenario that we painted, but ultimately you as the investor needs to realize what's your risk tolerance, right? Are you willing to put it all on the line? Are you willing to go out and flip a house? I remember early on, and even today, it's like, well, we're deep in this game now. I'm going to figure it out, right? Whereas, when it comes to stocks and other passive investments, I'm like, yeah, whatever. Like the returns don't do it for me. But for some people, they just want to continue producing income and earning out 8, 10, 12% with a pop here and a pop there, right? Like that's what motivates them. That's fine. But I think you really need to take the time and determine who and what you are. I think there's some really good, I know we've talked about this a lot, DISC personality. There's other personality tests out there to define who you are. And I think in this scenario, if your back's against the wall and you really are an entrepreneur, you're going to take that $100,000, turn it into $1 million, probably in less than 3 years. If I had to guess, it would probably way sooner, but I'm trying to be abundantly cautious. A real entrepreneur, someone that really understands business, is going to take $100,000, turn it into $1 million and put themselves on cruise control very shortly thereafter, and building something that's rinse and repeatable. Go ahead. Sorry.
And most of that stuff, if you were like, hey, I'm going to do this, most of it isn't even putting the money towards down payment money. It's taking that $100,000 and putting infrastructure in place and buying leads and market, creating marketing teams and things like that. Like that's what happens when you invest in a business. If you've ever owned a business before, the amount of, when we started Hard Money Bankers, I don't think we put $1 of our own money into these in at the beginning at all. So like, look at that, return, whatever that equals. Right. Like we were using, we were raising some investor capital. Like we closed our first loan, took the proceeds of the loan and, put that in the bank account. And that was our seeds capital to start marketing for new deals and opportunities like that. And I think that's really what it is. Now, again, most people listening or watching this, maybe that's not what they want. And they just want to take their $100,000 and put that into, good rate of return investment. And that's fine, but just call it what it is. That's a passive return, and I'll be the first one to tell you. And these are things that Ian and I have always done as well. And it's important is you take those chips off the table, or as that growth money, active money comes in, you take part of that and that money goes into your passive income bucket, where in essence, that goes into rental properties or promissory notes or business interests or limited partnerships. And then it's like, hey, this is working for yourself. And keep in mind, your money's earning that, not your time, right? That's why it's passive investments. So like you are tying up money to do so, right? Like, if you want to make, $10,000 or $120,000 a year and you can get a 10% return passively, you need to lock up $1 million to do so. Now, yes, you can take lines of credit potentially against some of that and arbitrage that. I get all that. But the point is you need that money to do so. Like it's more challenging to potentially do that, other ways. Obviously, you can buy rental properties with leverage and stuff like that can spit out passive income. There's an argument of how passive a rental property really is. Point being is that the goal is at the beginning is to massive active investing for very high rates of return in order to take chips off the table for passive investing. And even though I think people don't want to get around that because they want to keep pushing. Well, we all know that there's a big comfort zone when you know that money is going to be sitting there, every week, every month, every quarter, every year. And that bucket runs itself. And yes, your main bucket, in this case, what we're talking about, $1 million is losing earning potential because you took those chips off the table into a passive investment. And I get that. I think about that all the time. It's like, hey, if I just took this and went all in, I could turn that quicker into other things, but it also frees space in your head in order to, have your proactive bucket or your active bucket compared to your passive income bucket.
So let's talk about, we got a few minutes left. Let's talk about the person who has $100,000. They love their job. They want to diversify from the market, but they don't necessarily want to take on all the risk. What would your recommendation be to finding deals that make sense for them? Like, what ways could they partner with active real estate investors to get involved in real estate deals?
So we're talking about they don't want to do anything active.
Let's talk about I know a couple of your capital investors, like the government guys, they're some of the richest guys, but they still have a government W-2, but they found alternative ways to invest in real estate without doing the heavy lifting.
Yeah. So I think there's two ways to do it. I think there's like the passive, like the super passive side of I'm not an entrepreneur. I don't know the business space. I'm not very savvy. I don't know real estate. I think some of those folks will find, equities or, alternative assets kind of around like the 6 or 8% return, give or take. And then I think people that are more in circles that are trying to scout deals and work deals and be like the capital provider of those deals, I think they can get 10 to 12% returns with higher kickers, potentially for, putting deals or projects together. They can, let's say that, you have $100,000 deployed. It's like, hey, well, maybe I'll team up with an operator. Let's go buy this rental property. I'll put up the $100,000. You do all the sweat equity and let's split the profits. Right. That's a way to potentially increase your returns. Maybe they want to originate some notes from, real estate investors and, lend money privately to real estate investors, or they invest in a business and they invest in a limited partnership. I mean, some limited partnerships, can spit out, whatever, 6 to 8%, 10% dividends, pref payments, and then also have an ownership kicker that could spit your rate of return, to whatever, 10, 12, 15, 20, maybe even 30%, who knows, depending on the situation. So I think it depends on who you are and how active. I mean, here's the deal. Just take the word active and passive. How active do you want to be? How passive do you want to be? If you want to be, the least passive investor and have the safest return, there's probably some sort of, government product for you. Or figure out someone that you trust that does alternative investments and stick to that. And if you want to be the most active investor, you should be getting, 1,000% returns. I will say one little piece of advice is, betting on a jockey and betting on the horse, right? So the horse being, the investment vehicle. Like, I really like multifamilies. I really like, commercial properties, whatever that is, right? And then the jockey is the general partner or the operator or the person that's running it. And I think that's a good way to look at it is, bet on both, because both of them need to succeed, the asset class and the person that's running the project.
Yeah, I think that's smart. I think there's plenty of ways to get involved in real estate, whether you find a partnership that works for you where you're the capital and the other person's the operating partner. I think you could probably negotiate some good deals, because real estate's one of those industries that are capital intensive. They can be very illiquid, but with the right operating partner, they can be very lucrative to both parties. And there's enough room in the deals for both parties to make a lot of money. I also think there's plenty of opportunities through syndications, through investing in notes, through investing with hard money lenders, whatever it may be, that, you can get a decent rate of return. You just need to know that, like, hey, it's an illiquid investment. You're riding the ups and downs. Like right now, the markets are rough, dealing with rough patches. Distributions can get turned off. Notes can go bad. Things happen. And you got to remember that you're not in control of that situation. And that's where betting on the person that's running the deal is uber more important than anything else that you can do. So I think just being able to navigate the woes, the ups, the downs, just transparently, we're selling a property that we have a bunch of passive investors on. Haven't had a distribution in several quarters due to some cash flow issues and getting the place leased up. However, we're selling it and everyone's being made whole. It's a win, right? So, knowing what you're investing into. I think too many times people just say, well, I'm investing with the guy running the deal. Well, it's like, yeah, but you still need to understand the underlying asset. I think the most important takeaway from this whole thing is whether you're active or passive, you need to know what you're investing in. And, too many people take it from the standpoint of, I'll just put money in the stock market. It's like, well, you don't know who the CEO is. Do you understand any of their balance sheets and their earnings? I don't, that's why I don't invest in it. I'd rather say, hey, Jay, here's a couple $100,000 and give my money to him. And it's a trusted source that I know and understand what he's doing, and giving a couple $100,000 to Elon, who most likely would make me a ton of money by putting it in the stock market with Tesla. But then again, I don't know. So I think really, I think for your capital is the most important thing.
Yeah, I think the active and passive is an important part, and like, don't be thrown off by the massive percentage return you could get by being that active person. And if you only have $100,000, like, chances are you probably don't want just $1,000 a month on that money. And that's great. If that's what you want, you could. But I think most folks want to use that as quote unquote seed capital to build a business, a portfolio, assets to turn that into something much bigger. And then you can take some of that money out, put that into more wealth preservation, passive type of stuff, have confidence to use your winnings, call it, to continue to invest in. And then you have everything stuff. And obviously there's endless speed bumps along the way. I'm not stating that there's endless speed bumps, but that's part of the game. And, if you want to be active and in the game, those are things that you're going to learn that, you're not going to necessarily, you're going to learn it the hard way. You can hear it all you want. We can teach it. You can read it in a book, but until it happens to you real time, it's not going to hit home, but that's okay.
Well, here's the thing. You can't have it happen to you unless you're in the game. And when you're in the game, then you can solve for X, right? Like, so to sit here and contemplate what your tax issues are going to be by flipping houses, what's the point of doing that if you're never going to flip a house? Just go flip a house and then deal with the tax implications afterwards. It happens. Every real estate investor, every business owner, at some point you're going to have an issue with taxes. It just happens, right? So navigate it when it pops up. You're going to deal with it and you're going to move on from it, right? But I'd rather have the problem on my desk than sit here and contemplate. I was joking with my wife last night. We'll wrap it up here. and this does not take $100,000, but, you know, she's been cooking sourdough bread and making candles and doing all this stuff. And, you know, like the hot trendy thing is to put a farmer's cart out at the end of your driveway. And we're on a pretty busy corner. I said, why don't you put a farmer's cart out at the end of the corner? She's like, oh, that's a great idea. She goes, but I think I need a license. And I'm like, and I could just see her like starting to invest. I said, stop, just go make this stuff, put it out there. I don't think anyone's going to get sick from making bread because there's no active ingredients in it. We'll deal with the license afterwards. Go make some money. See if you even like doing it first. Then we'll deal with the problems. So just interesting to see how people's minds work. So hopefully you guys have a good takeaway from this. You figured out how to invest $100,000 to make it work for you and what's right for you in today's marketplace. You know, I'm sure if you re-interview us again in a year from now or even 6 months from now on how to deploy this $100,000, there'll be a lot of similarities, but there'll be a lot of differences. And the markets are always moving. And the important part is staying in the game, understand what's going on, and being able to be nimble to what's going on in the market. So if you guys got any value out of this, please feel free to share the show.
Yeah. And I think our answer to the first 100,000 is going to be similar. And I think most people you talk to will say the same similar stuff, and stuff that you do at a later date might be different than startup time. Just remember, we're not CPAs, we're not attorneys, we're not giving financial advice. We're just here talking about past experiences that we've had, and everyone's experiences will differ. That's our disclosure for this episode. We'll see everybody soon.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.